as we come to the back end of the conversation, there is one thing I want to pick your brain on quickly, and this is this idea of how perhaps index funds, and you've mentioned it off air before, quantitative investing is impacting the way micro cap investors such as yourself or small cap investors operate.
What we've seen, and passive funds have been available for a long time, but particularly over the last 2 years, we've seen a large inflow into passive and /quant funds in Australia, to a degree where today they almost speak for about 30% of share ownership in our respective asset classes, which might not seem like a lot, but it's actually massive. And what this means essentially is, and let me first say that we don't have any philosophical digression against passive and quant funds. We understand why they exist, and they provide a service to investors. So we're not opposed to their existence at all, and we're happy that they exist. However, at the end of the day, a lot of essentially the capital allocation process of passive funds is indiscriminate, and that has implications for our asset class. What we think is starting to emerge is a bifurcation of market pricing in small cap and micro caps because of this large prevalence of quant and passive funds. And so we've seen some companies that are priced at .com-like bubble valuations. And at a certain other end, we're seeing some companies priced at GFC-like valuations. I mentioned that we own a software technology company on 3.6 times enterprise value profit. That business you could not buy if it was private anywhere near those multiples. Even if you paid 60% more, you wouldn't be able to secure a business of that scale and quality, paying a 60% premium. And we think that's occurring because of this increase in the asset ownership of passive and quant funds, which essentially make the market more inefficient. Because coming back to what I said about active fund managers are agents of price discovery. So if more of the market is made up of passive funds, the market has less agents of price discovery, and there's greater pricing inefficiency, which for a value investor like us is a good thing.
Yeah, and you'd hope that through your activities or through the company growing itself, it closes the gap to intrinsic value.
Well, what we've actually seen on that, Owen, is we've seen over the last 2 months, we've seen heightened merger and acquisition activity across our portfolios. So we're seeing industrial competitors or private equity funds who can't buy like-for-like assets at these price points come into the listed space, offer large premiums to the mark-to-market valuations, and take control of the companies because they know that there is these huge pockets of undervalued high-quality assets. And in our portfolio, we've seen 5 merger and acquisition events over the last 2 months. And these are at very significant premiums to the market value.
I did notice in some commentary recently, one of your positions, GBST Holdings, it's a company that I've followed for years, and it's just seeing it get snapped up. It's one of those businesses, like you said, that have more value than probably the market is ascribing to it.